Hi, my name is Stuart Barron. I'm National Director of Research for Cushman Wakefield. We're standing on the beautiful second floor of the TELUS Hosting Center at 25 York, and I'm here to make sense out of the first quarter Toronto office stats for 2012. Two high-level observations I'm going to make to begin with. One is that vacancy is rising in downtown Toronto. Now that may sound unusual. AAA vacancy went from 5.8 to 6.7% in a single quarter. Class A vacancy in the financial core also rose from 4.3 to 4.7% in a single quarter, which is really surprising given what market conditions have been like recently. At the same time, if we take a look at demand, overall absorption across 2011 has averaged about 250,000 square feet a quarter. Now, if you take a look at the first quarter of 2012, we find that absorption was actually negative 140,000 square feet. Now, absorption is probably our best measurement of demand, so when I took a look at those two facts together, the question that comes in my mind is the market turning? Particularly with what's happening in Europe and a softening in overall global economic conditions and how it might be impacting Canadian central markets. But when we dug a little deeper, we found it couldn't be further from the truth. In fact, if you take a look at the transactions larger than 10,000 square feet in downtown Toronto, you find that over 50% of those transactions are in fact expansionary in nature. A second fact is if you have a look at future available space coming to market, we find that over 550,000 square feet of space returned to market in the first quarter. Those are the two factors that drove vacancy and absorption. Remember, we just got through a period, a very strong development cycle where over 4.5 million square feet of new developments came to market. The last development was 18 York, in the fourth quarter. And in that kind of a time period, or in that kind of a development cycle, what you end up seeing is a tremendous amount of churn as the tenants relocate in the marketplace and displace space. So we're always tracking a significant amount of future space that's returning to market. Now, as we look across 2012 and say, okay, fine, that's the first quarter, what's going to happen as we proceed towards over the last 3 quarters of the year? We're going to see moderate, really modest to moderate expansionary growth in downtown Toronto continue. It's going to gain momentum as the year, as we kind of move through the year. And additionally, we may or may not see vacancy rise slightly as a result of additional future space that's going to return to market. We're tracking another million square feet or so. It's going to hit in about 2 of the next 3 quarters. So you're going to see kind of a break from a tenant's perspective and some opportunities to find additional larger chunks of space. However, a good component of that will be in the AAA towers, which will see vacancy rise. Interestingly, if we look to 2013 and 2014, the future space trails off, and that's going to mean a tighter market and vacancy in downtown Toronto heading towards kind of a 3% sort of rate. It's going to be a lot of pressure in the market, and you're going to see rental rate pressure that's going to happen particularly in 2013, 2014, heading into what we're going to see, which is the next development cycle. That cycle is going to begin in the fourth quarter of 2014, and it's going to stretch into the third quarter of 2016. We're probably going to see between 3.8 and 5 million square feet of new developments come to market. What's really interesting about that is over 50% of those new developments are going to come in the downtown south market. Now, not all of that is locked in place right now, but that's based on best information in the marketplace. That's the summary for downtown Toronto. Continued expansionary environment and tighter market conditions, particularly in 13 and 14. If we jump over to the suburban markets, we've been surprised by the fragility of the markets. We continue to see kind of weakish absorption, negative 50,000 in the GTA East, plus 50,000 in the GTA West. The West is a lot more active in the East. The West has seen a number of significant transactions complete over the last couple of quarters, particularly in the first quarter. However, many of those tenants locked down on space that represents future space, future availabilities. So it really didn't have much of an impact on the current availability rate. At the same time, what we expect to see in the future is additional expansions in the GTA West, but we're also seeing a lot of consolidations, displacement of space, shadow vacancy come back as certain types of industry downsize. Where we're seeing the expansions in both the East and the West are the engineering companies, the health, the professional services companies, and that sort of sector. The GTA East has been quiet for a couple of quarters, but its vacancy rate is sitting at about 8.8%. It's relatively flat. We expect momentum to pick up, and it won't take much to begin putting pressure on rental rates in the East. That's my summary of the suburban markets, and it's my pleasure to come to you today and talk to you about both the downtown and suburban Toronto markets. Thank you for joining us and listening to Cushman & Wakefield's quarterly MarketWatch video. Stuart Barron, Cushman & Wakefield.